Are you interested in investing in stocks but have a lot of questions in your mind? Whether it is right for you to invest in stocks and how to go about doing your own reading up and investing in stocks? What proportion of your wealth should you invest in stocks? How many stocks should you own? Which sectors should you hold? If you have those questions in mind, you should listen to this YouTube video. And before I proceed further, please subscribe to our channel so that you have more insights. I would also suggest that you go and visit primeinvestor.in varsity, where you will have a wealth of information on investing in stocks, mutual funds, etc. It will be a great way to start learning about investing. Now let's dive right in. The first question, for most of you is that you're not a full-time investor. You have a job, and with other jobs, you have to, learn to invest in stocks, and you need to know how to build a portfolio. How do you start? The ideal way to start is not to be really just going about surfing on the net for quick 5-minute videos, although this one will provide a foundation for that. You can start reading books and blogs on investing. A good book, specifically for Indian investors. Many of you read a lot about probably US, investing and all that, which may not be entirely applicable here. So good, place to start kind of reading up is the late Parak Parikh's Value Investing and Behavioral Finance. It's a good book to start. Then you have Stocks to Riches. You have Masterclass with Super Investors by Vishal, Mittal, and Saurabh Basrar. And you have Thoughtful Investor by Basant Maheshwari. There are any number of other global, great investors books such as Peter Lynch, Howard Marks, Pat Dorsey, and so on, which you can study to understand techniques of investing. But do start with the Indian, books to give a better understanding of our landscape. Of course, you can also read a wealth of information comes from Warren Buffett's annual newsletters to Berkshire Hathaway shareholders. And in the Indian context, you have blogs from Fundu Professor Sanjay Bakshi. You have Dr. Vijay Malik, and then you have the Value Picker. These are some of excellent sources to learn the basics of stock analysis, understanding balance sheet, how to select a stock, and so. If you're a little more seasoned investor, you want to do your own stock models, you want to do your discounted cash flows and all that, then you have Dr. Ashwath Damodaran's blog. Everything there is downloadable, everything there is free source. You can get into the habit of kind of going there and do some self learning. Other than this, of course, if you're tracking stocks, you ought to be reading business newspapers, magazines, and dissect the corporate action and what bearing it can have on the companies that you track. So that's the first step. And please remember, when you do all this, you should simultaneously try and start investing by starting with small sums. Do a dry run with a model portfolio, before you move to the real thing. So that's the first question on how do I get about investing in stocks with other jobs. It's a lot of reading and understanding, folks. Right. Now, the next question is, many people dissuade you from investing in stocks. Your financial advisor or your distributor tells you that investing in stocks directly is not a good idea. Start with mutual funds, start with index funds, and so on. How do you go about convincing them, or rather convincing yourself, that you can invest in stocks? Right, there are things that you can do in stocks that you cannot do with mutual funds. With mutual funds, yes, you can average using SIPs, but SIPs don't really allow you to buy that low or sell that high. It's about averaging over a period of time, hoping that you'll also go through a low phase and a high phase. But with stocks, especially when you track them and you set yourself price targets, it's very possible to get into stocks at a reasonable timing, make rich dividends, make rich returns, and also exit if you are a good analyst tracking the stock. So, stocks essentially give you that real thing of timing the market. In stocks, it's all about timing the market. So, that becomes very, kind of a big deal that you can do with stocks that you cannot do with mutual funds. The other thing, with stocks is that you can decide to buy the stocks that you want. Every mutual fund portfolio will largely have the highly researched stock, your HDFC or your Infosys or your HUL and so on. But as a retail investor, Since you are constantly looking for, the multi baggers, you can look at under research mid cap, small caps, and invest in them. You can isolate and invest in them instead of holding it with a large portfolio of mutual funds, right? So these are some of the benefits that you have of investing directly in stocks over mutual funds. And these are the points that you need to tell your advisor and to also convince yourself, if you really have it in you, to put in the effort to invest in stocks. The third question that people often ask us is, what proportion of your total corpus or your wealth should you invest in a direct stock portfolio, and also how many stocks should you own? Now there is no one size fits all to this question. All right. um, First is to determine your equity allocation. If you have a financial advisor, they may have already told you, look, for your risk profile and time frame, you go with 60% in equity, you go with 70% in equity, or go with 50% in equity. Once that equity component is decided, now only out of this equity component can you actually carve out some amount for stock investing. Please remember, it's not outside of the equity component of your mutual fund. So you have decided, for example, 60% will be in equity. Now if you're a beginner, you should start with, out of the 60%, maybe 50% will be in mutual funds, and 5 to 10% can be started in stocks, right? And then you could possibly slowly increase it, and so on. How do you protect yourself when you're starting off? Make sure in your mutual funds some amount is allocated to index funds. That way you are sure that you are going with the market. The reason I'm saying this is, if it's fully with active funds, you are trying to do your own fund management, but with this 5 to 10%, and the remaining 50% is with a lot of other fund managers. So both are active. If you get your calls wrong and the fund managers also get your calls wrong, the portfolio can really go down. So instead, hug the market with some amount of index funds. It's always a good idea when you're a stock investor to have some proportion in index funds or ETFs, passive funds, those that track the market, like the Nifty 50 or the Nifty 500 or the Nifty mid cap 150, and so on. So if you keep some proportion there, some proportion active funds, start off small with 5 to 10%, and then as it grows, you can start building a portfolio out of it. Again, on the number of stocks to own, there are no hard rules, right? It depends much on the corpus. If your corpus is small, you can't own 10 stocks. Even the price of the stocks may be high for you to own that many stocks, right? And so you start very small, and as your corpus grows, many seasoned investors hold anywhere between 12 to even 30 stocks in the portfolio. 12 to 30 stocks give adequate diversification and ensure that monitoring doesn't get too difficult. Very seasoned investors believe in even a smaller portfolio of even up to only 15 stock. I personally have more than 15 stocks, but that's to do with the nature of what I track. I love a company, I try to invest in them subject to all the regulations, rules that are there, and then it goes on adding over a period of time. So there are no hard and fast rules, but yes, this is the number. As your corpus goes to several lakhs, anywhere between 12 to 30 would make for a, remember, the Sensex has a 30 stock, the Nifty has 50. That gets too difficult. But even small portfolios are fine. The problem with very small portfolios is, if your corpus is large, your exposure to individual stock is so heavy that after a point, if something goes wrong, a single stock can pull down your portfolio. Just look at mutual funds holdings. You will see the stock weight ranges, even in focused portfolios, anywhere between 5 to 10%, right? So if you have 10 per 5%, in each, imagine the number of stocks you'd have. It would be around 20 to reach 100. If you have 10%, it will be about 10 stocks, right? So start off with that. Have a cutoff on how much you individual stocks can go to before you will prune it. So take clues from mutual funds. That's about the number of stocks. The next thing is about the ideal sector weights that one should give. Should you decide on sector weights even before picking stocks? There are two ways to look at this. Okay, one is to look at the index itself, the Nifty or the Sensex, and look at the sector weight. For example, in the Nifty, financial services and banks have a very high weight. You might want to also mimic your portfolio with a high weight to the sector if you want to hug the market. You don't want to go too contrary to the market. If the market has rewarded financial services and it receives high weight, then probably you should have. If the market has rewarded IT and receives a chunk of the weight, you could pause. So this is playing a little safe, right? So you don't need to have, say, 40% weight to financial services, but in your overall portfolio, you can have higher allocation to financial services, other, compared with the rest, if the index also has the same. The other way, and a better way, I would say, of looking at sector allocation is to ensure diversification with different kinds of play. Yeah. So how do you do that? This is done to reduce the downside. For example, if you have, say, exposure to consumer appliances or FMCG goods, which are more of a domestic economy play, then you can have something like an IT sector to have a global play, because IT is largely into exports and all that. Similarly, if you have same consumer sectors, or any sectors that are very defensive, you can make it up with, say, something like capital goods or infrastructure that will be more cyclical. So you basically have different strategies and styles of sectors in your portfolio. So growth oriented and defensive, or it could be global and local play, and so on. So this will ensure that you have sufficient diversification. What does it do to your portfolio? When one sector falls, at least all the cyclical sectors fall, your defensive sectors are still okay, they're holding up, right? So your portfolio hit will not be too high. Similarly, when there is a rally, maybe the cyclical will do better, and you might, that's okay. If you had consumer goods, it helped you in the down market, but then there is a rally, the cyclical sectors help you. So this is how you do. So you don't necessarily need to set sector weights before selecting the stocks for your portfolio. The ideal thing, if you're a very seasoned investor, is to do a bottom up process. Basically, you look at companies, you create a list of companies that you like to track, you look at them, you look at good price points to enter those stocks, and you invest in them. Over a period, they get diversified. Nobody starts with a very diversified sector and diversified style and strategy and so on. I personally, when I started with 3 stocks, 4 stocks, how could I have had any diversification, right? Over a period of time, it built itself. And when I look back now, I realize I actually am overweight on financials. I never did that consciously, but I ended up going with the market flavor, and ended up doing that. So that's what happens eventually to portfolios as they grow. But to begin with, a bottom up investing style is also good enough. The next question, which many people have, is whether it's a good idea to do SIP in stocks instead of making lump sum investments. We think SIP is only better suited for mutual funds than stocks. Or if you're buying a basket of stocks, like a small case portfolio of 10 or 12, etc., then you can, because they are but if you're buying individual stocks, timing is a big contributor to stock returns. And SIPs tend to put your investments on an autopilot mode. And what happens is that you might, especially in a stock that's rallying, you might be simply doing SIP at every higher price, and that's not going to help you. So what do you do? In stocks, it is always good to set buy price targets for yourself. Whatever method, 10% below what you already bought, and buy them in tranches. In fact, when we recommend stocks, we occasionally give out average calls. That's what we do. So we look at valuation. We look at valuations where the stock becomes attractive and give an average call. You could do that. You could have price, if you are very bullish on the stock, you could simply have price targets based on those valuations, and monitor that. Keep it as part of your daily stock monitor. And that way your portfolio, especially when SIPs, they can get neglected. You might not even know that a stock is not doing well, a company is not doing well, and you might be pumping more money into it through SIPs. All this can be avoided if you do this investing in tranches. Okay, then we come to the last question here. Whenever there is a big market correction, like it happened in May 2020, or before that, in several markets in 2015, for example, should you simply exit because you don't know what's going to happen next, and re-enter when the mayhem is over? We don't think so. It takes a lot to enter stocks at certain price points and then hold on to them or accumulate them, etc. And Sometimes when the market is in a euphoria, some of the indicators can go totally wrong, like your PE might look very elevated, your PB might look very elevated, and you start panicking. It's peak, I'll exit. Remember, at sometimes when you entirely exit looking at very traditional metrics, you can go entirely wrong. In fact, today I had a question on somebody who had put various PE bands and asked me if these are levels to accumulate more, go all out, or exit, and so on. We don't subscribe to such a strategy at all. For example, in 2000, early 2015, if you had exited equities because the market was had already looked elevated, you would have lost another 70% upside on the Sensex, right? So that's huge. So exiting entirely is very different from periodic profit booking on stocks that look inflated. So what we recommend is that you do periodic booking of profits based on your asset allocation. For example, you have a 60% equity allocation, including your mutual funds and stocks, which has gone to 75% in a market rally. Bring it back to 60% by booking profits in stocks, especially small caps, mid caps, which have run up, and then in mutual funds where you had taken tactical positions, sector funds, and so on. But selling them all is not an option, because you will never ever get the timing right in terms of entering them again. you know if you had lived through the market bottom of March 2009, or even October 2008, or March 2020, you will know entering is very difficult, and you have exited a large sum and you're trying to pump them back again. It's even more difficult. So don't ever make the mistake of exiting in one shot. Do this periodic profit booking. Forget the market, look at your own asset allocation. If it's inflated, bring it back. That's a simple way to do it. That's all for today.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.